defending the free market, and making the moral case for capitalism. The Justin Moore Show. Hey everybody, welcome to the Justin Moore Show. Now, as promised last week when I was talking to you guys about FreedomFest, I said for this next episode I would release my panel discussion that I had at FreedomFest. And for any of you guys out there who are, you always hear me talking about, oh, you got to go to FreedomFest. There's so much great stuff going on. There's so much you can learn. And just listening to this panel discussion here, you'll see how much value there is at FreedomFest. And this is just one of many panels. There's probably over 100 panels that take place at FreedomFest over the course of 3 days. And so this is about a 52-minute long panel discussion. Now, I tried to amplify the volume, and for some reason my audio program wouldn't let me do that. You will still be able to hear it. It just won't be as loud as I ideally would like it. And one other thing before we get started here and I start the panel discussion, this is actually the 100th episode of the Justin Moore Show. Yeah, I just went and checked iTunes, and so ironically enough, it's a very special show. So here you get to hear from 5 experts talking about the economy, what's to come, what does negative interest rates mean? We talk about gold. What's the future for gold? There's so much great stuff that's in this, so make sure you listen through the whole 52 minutes. Without further ado, here's the panel discussion from FreedomFest that took place on July 15th, 2016. Let's play it.
All right, hey everybody, welcome to the Austrian Economics panel. I am Justin Moore. I will be moderating today. I have, just really quickly about me, I have a little podcast. I talk about Austrian economics, and I also farm in Montana. So now, before we jump to our panel here, I just want to quickly set the table. We look at the economy today. We've had interest rates near 0% for, 7.5 years now. We've printed trillions of dollars into the economy, QE1, QE2, QE3. We've passed stimulus bills, jobs bills, all sorts of bills. And, what do we have to show for it? We've had these politicians saying, hey, we're in a recovery. Well, 2008 was 8 years ago. And here we are still kind of struggling along. And heck, it was Joe Biden in 2010 that said it was recovery summer. Well, that was 6 years ago. And just look at what happened over just a few weeks ago with the Brexit. And then you see Donald Trump. He's a Republican nominee for president. A lot of people didn't expect that. I certainly didn't. Then we have Hillary Clinton, who almost lost to Bernie Sanders in the Democrat primary. To me, this says that a lot of people are losing faith in the system. A lot of people are losing faith in government. Now, from a libertarian point of view, that's a good thing. But when we have a world that's made up of fiat currencies, what happens when people lose faith in the currency? What does that mean for the economy? Well, on that healthy note, let's turn it over to the panel. These guys can actually tell us what's going on in the economy and what's to come. So we'll start with Keith Weiner. Introduce yourself. Let's work our way this way.
I'm Keith Weiner. I'm an economist, fund manager, and all around everything to do with gold. You want me to answer your question, or is this
No, not yet.
This is introductions. Okay.
Introductions.
Hi, I'm Adrian Day. I'm also a fund manager, and I guess an author or writer.
I'm Chris Casey, Managing Director with Windrock Wealth Management. We're a wealth management firm that believes in and uses Austrian economics, and I'm a little bit squeezed up here, but that's about it. Go ahead, Gene.
Gene Epstein. I'm the economics columnist at Barron's. I've been writing a column on the economy for the last 22 years. I am an Austrian economist, but of course I do report on government numbers, and I have probably a little bit more respect for those crazy numbers than some of my colleagues do. We'll see.
Robert Murphy. I'm with the Free Market Institute at Texas Tech, and I also do a lot of consulting for the life insurance sector.
All right, so let's. I wanted to ask everybody the same question. Let's get your take. Is the 2008-like crisis, is it right around the corner, or is it well into the future? What's your guys' take on that? We'll start with you, Dr. Murphy. Do you want me to use that? Yeah.
Okay, so I'll just be really quick. If you go and chart the S&P 500 index against the Federal Reserve's balance sheet, it is shocking how much those track each other, like hand in glove. And so from the framework of Austrian economics, I think that, yes, to answer your question, they have blown up another bubble. And my reading is that they brought in Yellen to be like the fall, not guy, girl, and that her orders basically were, we're not going to expand anymore and try to make this as soft a landing as possible. But the Fed has not expanded its balance sheet since fall 2 years ago, and the stock market has basically tread water since then. So a lot of libertarians are like, oh yeah, the Fed just keeps inflating. Well, they actually haven't been since they brought her in, that she oversaw the taper and so on. So this isn't economics, this is more psychology, political economy, but I think things would have to get really bad before they did another massive burst of QE. So my prediction is, they would wait for another crash before they pumped in more money.
I don't think that a recession is imminent this year or early into next. I believe that we sort of we're groping, with the blind men groping the elephant to see whether he has a tail or a trunk or whatever, and different takes on where we are in terms of indicators show that a recession is not imminent. In particular, I respect what Bob Murphy has just said. In fact, I'm in awe of Bob generally. But another take indicates that the stock market is not especially overvalued. Bob might say, well, I'm looking at the wrong way, but here's the indicator. It's not price-earnings ratio, since earnings are kind of a dicey number, but it's dividend payouts. Cash dividend payouts. The 400, the Wisdom Tree Index of the dividend yield on the 1,400 stocks that pay dividends is actually in very modest territory. It's a 3.06% dividend yield. Now, given where interest rates are, it should be a lot lower. Though what that indicates is that prices have been relatively conservative. So I don't think that's toppy. In addition, by the way, one of the indicators that almost has no false alarms, economists like to call this false positives, I call it false alarms. You pull an alarm off and there is a fire. Oftentimes there's a false alarm. The stock market is filled with false alarms. It's predicted 9 out of the last 5 recessions. But one of the indicators that is almost always accurate is that there's an inverted yield curve. And the yield curve, you might say, well, there are reasons why it hasn't inverted, but we do not have an inverted yield curve. Before every recession of the last, going back to World War II, we've had an inverted yield curve signaling a recession. Those two indicators tell me that this very, very slow expansion, I do think it's an expansion, people are better off, more people are working, will probably muddle through for at least another year or so, or more perhaps.
So I agree with Gene. Obviously, we don't have a yield curve that's inverting, but it's certainly flat or flattening over the last couple of years. I mean, you could look at that from an annual basis, or you could just look at the 10-year Treasury spread over that of the 2 years, and you can see it diminishing. I think it's now at the point where it's so narrow, it has been like this since 2007. So, is a recession imminent? Yeah, Monday. It depends what you mean by imminent. I certainly don't think it's imminent, but I think if we're sitting here next year, we may very well be in a recession. I don't think that's unlikely at all. I think it's likely. If a recession happens when consumers reassert their time preferences and you have interest rates reestablish themselves as a natural rate, the only way to stave that off is if the Fed or central bank continues to inject money into the system. And like Bob mentioned, they're not. So it wouldn't surprise me, given the way the yield curve is flattening, given the severe stress we see in the banking system, if we do have a recession in the near future, although albeit not necessarily imminent.
Yeah, I guess in the near term, I'm somewhat sanguine. I would tend to agree with what Gene Epstein had to say. I don't think a recession is imminent, and I actually agree with what he said about the stock market. I think we throw, and I'm not talking about Gene, we throw around the word bubble just a little bit too often. The stock market's not a bubble. It might be overvalued. But it's a little bit overvalued on a historic basis. It's certainly not grossly overvalued. It's certainly, in my view, it's certainly not in bubble territory, which implies an exponential rise and gross overvaluations. We're not there. And a mania. I mean, everyone's not, you go to dinner parties, everyone's not sitting around talking about the latest stocks they just bought, as they were talking about the tech stocks in 1999, and they were talking about, the latest fix me up that they just bought in 2007. So, those are indications of bubbles. So we're not at bubbles yet, I don't think. But I should say, I don't want to sound like a Pollyanna. I mean, I think this economy is fundamentally in very, very bad shape. Yes, household income has gone up. Yes, household net worth has gone up. But if you look at household net worth for the majority of people, it has hardly moved since 2007. And that's a very, very dangerous sign, and that's obviously reflected in the politics we were talking about.
I think it's always very difficult to predict the timing of these things. So with that said, I'm very much a believer in, there's an old adage that when stocks are opposing credit or bonds, it's credit that's always right. And so, I'll agree with one of my colleagues who was talking about the flattening of the yield curve. In a zero interest rate environment, it's difficult to really imagine what inversion might look like. But with 6 months LIBOR has been moving up. It's about 1% right now, just a hair under, and the 10-year Treasury is at 1.4%. So that's incredibly flat. Now that does a couple of things aside from just being an indicator. This is the bank's profit margins. So their ability to service their debt and their ability to do everything that they need to do is absolutely getting crushed. Another spread that I would point to as perhaps not a healthy sign is the spread between junk bonds and treasury bonds. And that is wider now than it was during the worst of the 2008-2009 crisis. So, think about this for a minute. So obviously not all issuers, and probably most of those dividend stocks, are not junk rated. But, if the price of the bond is falling significantly below par, that means the market is expecting a default event of some sort. If the company is going to default on its debt, that means its equity is worth how much? Zero. And so if the equity is continuing to levitate while the bond market is saying that, 30 cents, 40 cents discount on the dollar, there's a contradiction there that I think at the end of the day, which won't necessarily be tomorrow, I don't see anything about to blow up in the next, 24 hours perhaps, but at some point that's going to matter, and when it does, it can be very violent.
Okay, Adrian, you mentioned that you don't see a bubble in the stock market, but where are the bubbles taking place right now in the economy?
Well, of course, your question, you beg the question that there are bubbles. Now
investments. Then.
Yeah, I certainly think, it's difficult to call the bond market a bubble because interest rates are so low, so where should we be going, and what should have happened to the bond market over the last 5 years? The bond market should have gone up, given what's happened to interest rates. But I can't help thinking that the bond market, we are building up for an enormous crisis in the bond market at some point, and that may not be for another couple of years, and it's going to affect bond funds, even more than it's going to affect individual bondholders, because of course a lot of the bond funds have a certain degree of leverage because they are using leverage because they have to boost those lousy returns. And when the bond market turns, a lot of long-term holders of bonds just continue to hold the bonds to maturity, and they get paid off with dollars that are worth less, but they get paid off, so they're happy. But if you're in a bond fund and bonds turn, you redeem your bond fund. So the bond funds are going to have to liquidate a lot of their bonds at losses, and if they're leveraged, those losses are going to be exaggerated. So I think that's an area where there's going to be trouble ahead.
If I could just interject, there's another crisis brewing, and that is of those long-term holders of the bonds. Look at the pension funds and insurance companies. And so a couple of months back, Central States Pension Fund announced, we're sorry, there's going to be a 50 to 60% haircut on pensioners. So these pension funds rely on the bond to pay a real rate of interest, and the lower that goes, the more that they're not in it for the capital gain, they're in it for the coupon. And when the coupon goes away, they're all dead. So I would look for an enormous crisis, not necessarily 2016 or 2017, but an enormous crisis coming to insurers, and companies that run annuity funds and pension funds for sure.
Well, we definitely have an interest rate. We Austrians say you never know where the real market interest rate should be, but it's a fair guess that it's higher than where the Fed has put the short-term interest rate. And we have distortions from all over the world because the U.S. economy is screwed up, but it's less screwed up than all the other economies, and so money pours in, but that is essentially unsustainable. The answer to the question about when we will get an inverted yield curve is when Janet Yellen and company decide that they're finally going to put the short-term interest rate back above 1%, 2%, where it's certainly approaching where it should be. Conventional economists like John Taylor point out it's way too low. So that will certainly do the market in once they start doing that, or most likely will, but I don't think that's going to happen for a while. The other risk, however, is obviously if you maintain interest rates this low then for so long, then you run the risk of incurring a bubble, and we could start to see it in housing, we could start to see it in the stock market. A real bubble, I believe, has not yet happened. Contrary to Alan Greenspan's claim you can never tell a bubble, we can tell more or less that bubbles are forming. We knew even before the bubble burst in 2000, 2001, that there was a stock market bubble. We knew that there was a housing bubble forming. It was fairly obvious just on the basis of just house prices, for example, fairly obvious in the case of the stock market in terms of dividend yield or price-earnings ratios. And so those indicators are fairly reliable. The point is that I think that we are on borrowed time. The ultimate blow-up, of course, the Dow dollar death spiral, the Dow dollar death spiral being that if there's a lack of confidence eventually in the U.S. ability to service its huge debt because it's got unfunded liabilities of $50 trillion, and if interest rates then really go sky high and bond prices plummet, then there might be a flight out of the dollar, out of our equity markets. I don't think that's likely to happen over the next few years. My only point is that I'm trying to outline where a year from now, 2 years from now, if Yellen is still keeping interest rates very low, we probably will begin to see what we haven't seen yet. For example, house prices are high, but on an inflation-adjusted basis, they're not that high. Stock market is high, but it's not on high on an inflation-adjusted basis or on a yield basis. But it's getting there. And so my point is that either Yellen will begin to hike and probably begin to cause an inverted yield curve, or if she doesn't hike, then we'll eventually see bubbles forming in stock market, housing market. Way further down the road, probably, we might suffer what I call the Dow dollar death spiral. So I'm just reassuring you that I'm not a Pollyanna. I do see bad things possibly happening. I just don't see them being very likely over the next couple of years. Ironically, it may well be because this expansion has been so slow, and certainly what my colleagues have pointed out about how it hasn't done that much good to the average person. Obviously, the average person is better off than that person was in 08 and 09, but it certainly hasn't delivered very much. It's been the slowest expansion on record. That may be partly why we're not headed off a cliff over the next year or two.
Okay, so here's a question I have. What is the Austrian, this is for you, Dr. Murphy, what's the Austrian take in regards to the velocity of money? Because you hear the monetarists, that's when inflation happens when the velocity picks up. Well, what do the Austrians think about that?
Yeah, so I think it's safe to say in general, I know Mises wrote about this and Murray Rothbard, they don't like even that terminology, right? So it's like the equation of exchange, MV equals PQ, and the intuition is picture all the dollar bills, and on average, how often does a dollar bill change hands, and then that total amount of turnover must equal total spending over the given time period. So they were pretty explicit, saying this is not the modern economics. This is not subjective individual valuation, the way economics works at a micro level. This is a completely different framework. So they don't even like thinking in those terms. So I think that's the first thing. And then as far as the rest, I mean, that's just to them like a backwards way of saying, like, what's the demand to hold money? And so again, it's more of a methodological point that to not think of it in terms of the movement of these physical dollar bills or electronic dollar bills, but think of it in terms of individual valuation. If you want to talk about the demand to hold money or to get rid of it, fine. But speaking of velocity, as like they say, that doesn't sound like economics to them.
Hey, can I just add something? Because this is kind of a pet peeve of mine when people talk about velocity of money. And the Fed certainly believes in it, right? They think that as long as this so-called measurement is at a low point, you're not going to experience significant inflation in the economy. But they're completely wrong, as Bob was just mentioning. I mean, think about it like this: the stock market every day, the stock market could go up or down depending on you're looking at an index. Well, the supply of stock doesn't really change. The number of shares doesn't really change that much day to day. Well, the demand changes quite a bit. But you could have demand, you could have stock markets go up or down on light or heavy volume. So to the extent that velocity is anything, maybe it's some indication of volume. It's certainly not demand. And the only thing that causes or determines a price level in an economy is the supply and demand for money, not velocity. And to the extent they try to use it as a proxy for demand, I mean, they're completely wrong. So this is a real danger that the Fed has embarked on. To the extent they believe this, they're believing in an artificial barrier to price inflation, which doesn't exist, and it could come back to haunt them.
Well, let me elaborate on what my colleagues have said. Henry Hazlitt, I think, wrote best about this, trying to think in simple terms. First of all, what's the velocity in the consumer sector? Well, if in Weimar Germany you rush right out the moment you get your paycheck to buy your eggs and meat and whatever else for the week, then it doesn't change your velocity over the course of the week because all your money is spent in an hour. And what's the velocity on a business level? Well, business is passing stuff back and forth, and it depends to some degree on whether there's a lot of vertical integration so that there's few cash transactions. The real velocity, the real name of the game with velocity, as he points out empirically, is of course in the speculative markets. You could have turnover of stocks and turnover of money, but that could, if volume increases. So if you think about what this turnover issue really means, then by and large there could be a lot of velocity in the speculative markets. But for the most part in the real economy, velocity is not really going to change very much, just in terms of the physical fact that business, there's B2B transactions and consumer transactions. So I think it's a blind alley. But by the way, I want to add one thing, which is that I did not expect there to be price inflation, even price inflation as conventionally defined in the consumer price index or the producer price index, because I believed that what was key was that the labor markets were slack, and that key commodity labor, it's got to respond. It's got to be tight enough for inflation to begin to ignite. That while money is necessary condition for price inflation, but not sufficient. However, now that I believe that labor markets are getting tighter, there could be some disturbing price inflation in a year or two, and that could induce the Yellen. Well, because the Yellen Fed has been looking for higher inflation. Ironically, they're really nuts on the subject of higher prices. But in a year or two, it could start to disturb them, and that too could ignite a problem. They might start raising interest rates if inflation, conventionally defined, goes to 3 and 4%, which I think is possible given the fact that the labor markets have gotten tighter. So again, I see some worry a couple of years down the road.
Okay, Keith. So when we look across the world here, we have negative interest rates in Switzerland, Germany, Japan. What does this mean to have a negative interest rate, and how is it possible?
Well, what it means, in a normal world, if you run an enterprise that destroys wealth, destroys your investors' capital, you should be out of business, and the sooner the better. But if the interest rate is negative, so suppose your enterprise is destroying its capital at the rate of 1% per year, but you can borrow at minus 2% per year, you're profitable. at least in terms of whatever currency is giving you a negative interest rate. So it is literally a perverse incentive that nakedly encourages and rewards with a profit and encourages you to scale it up as big as possible, wealth destroying activity. So that's what it means. Now, how is it possible? I have a different view than most others. In my view, the paper currencies are a closed loop. Right, so the chief advantage in the gold standard, and by gold standard I mean gold coin standard, is that if you don't like the interest rate or you don't like the risk of the banking system, you can take your marbles and go home. And that forces the interest rate to tick up because you are pulling coin out of the banking system, which forces the sale of a bond somewhere along the way. And so the saver is empowered to have an input into the interest rate. But in a paper system, we're disenfranchised. So suppose you're a saver and you're sitting here looking at whatever your bank is offering you, which in some cases is negative, and you might decide, okay, I don't like that. I don't like 0% or I don't like minus 1%. Well, you can exchange your bank deposit for some other asset, which could be perhaps a very overvalued piece of real estate. It could be wine. It could be antique Ferrari. It could be stock. It could be whatever. But the only thing that happens in the banking system is they change the name on the record of the deposit. It's no longer Keith, it's now John Smith. You've had literally zero impact on the banking system or the interest rate. And so, in a certain sense, we're penned in like animals in a pen, and there's no exit. So the dollars can change hands, the euros, the Swiss francs, the Japanese yen can change hands, but nobody has any real effect. The interest rate is a whole separate dynamic, moving in whatever direction it's moving for a variety of other reasons. In the meantime, it moves negative, right? So in Switzerland, the entire yield curve is drowning underwater, all the way from the overnight bill or whatever they call it to the 50-year bond. There's not a positive yield to be seen anywhere. And you think about that. So 18 months ago, I created some controversy. I wrote an article called "The Swiss franc is going to collapse." I pissed off some people writing that. Interestingly, not in Switzerland. It was very well received in Switzerland, but elsewhere. And my argument was, so they had their peg to the euro, which snapped violently at that time, January 2015. But the other thing that happened, and obviously everybody saw that, but the other thing that happened, which got a little bit less fanfare, was all of a sudden all their interest rates snapped downwards. And so at that point in time, the 10-year was negative. You had to look to the 15-year to see a positive yield, and I think it was like 3 basis points or something. And I said, based on this, my prediction is this currency is done. Not imminently, not necessarily in the next year or maybe 2 years, but it's done because it's now an open incentive to destroy. And when that picks up steam, it's all over, no matter how many people around the world. And I like to use the term, the Swiss franc is considered to be the gold standard of irredeemable fiat paper currencies, deliberately to create that violent analogy. So it's very popular, and so there's this inrush. There's always this bid on the Swiss franc. But the destruction there is explicit, it's naked, and it must be reaching a horrific pace at this point.
Well, I just interject a point in terms of course, in terms of simple human action. If government is offering you a negative interest rate, then of course you're paying them to store your money, and your alternatives are, of course, your mattress or a safe deposit box. And as long as, but you feel it's reasonably safe with government, and maybe the safe deposit box is going to get robbed, and so they do have you cornered. So it isn't irrational to pay the government to store your money if that's the best you can do, and if your alternatives are only a safe deposit box or a mattress, that's how they get away with it. Simple enough. But indeed, of course, the very low interest rates and negative interest rates that, in terms of inflation, certainly in this country, have been especially punishing toward people of limited means who've saved their money. People over 60 who like to buy bank CDs and who constantly get calls from brokers down in West Palm Beach retirement communities. You don't want to park in a CD, buy a stock. Do something that you wouldn't normally do because the yields are so punishing. And that has indeed been one of the ugly sides of this low interest rate policy, the punishment of elderly savers who like to put their money into bank CDs. But negative interest rate, of course, is not that much of a mystery in terms of the options that people are offered.
Okay, Adrian, gold and silver, they've been the best performing assets of this year, or one of the best. What's your take for someone out there who's kind of missed the rally so far? Is it too late to hop on the bandwagon, or what's your future prospects for gold and silver?
Yeah, I love the way you phrase the question. I'm very, very bullish on gold over a 1, 2, 3 year period. Very bullish. For a lot of reasons. One is the ultra-low interest rates and the fact that rates continue to go down and any prospect of hiking continues to be pushed further out. And I think that's going to continue to be the case, let's say for the foreseeable future. So that's definitely one major reason that I like gold. Events like Brexit and what that opens up for the uncertainty about the European Union, with a majority of Italians wanting to leave and with very strong anti-EU movements in France and in Holland, among other places, it opens up a lot of uncertainty, and that is also very good for gold. I think the reason that I don't think it's too late to jump on board is that there is an awful lot of money on the sidelines, an awful lot, and that's retail money and institutional money. Remember, we had a 4-year bear market where, gold went from 1900 to 1100 or 1050 or whatever, but the gold stocks were down 85%. The senior gold stocks were down 85% in those 4 years. So it's been an exceptionally punishing bear market. People, understandably, were not in too much of a hurry to jump back when people like me said, look, these things are so cheap, you just got to buy them. People would say, well, I think I'll wait until things look a little bit better. Now things look a little bit better, people think they've missed the rally. So there's an awful lot of money on the sidelines waiting to get into gold. And that's why every correction we've had so far this year, just for people who don't know or aren't gold investors, there is typically a large correction in gold, starting sometime in the middle of March and ending sometime in July. And it's almost regular to have this spring pullback in gold. We haven't had it this year. The pullbacks have been remarkably brief and remarkably shallow, and that's because of people waiting to get in, taking their opportunities. So I'm quite bullish.
Can I ask a question about gold?
Yeah.
My own framework about gold has been simply that the long-term bear market in gold that started in the mid-'80s was, of course, because of the great. Now I'm forgetting what it was. What's it called? It was the Great Moderation. Thank you. It was so dim in my memory. The Great Moderation, when there was a certain amount of confidence that Alan Greenspan and others could manage the economy, and then and there was a bear market in gold. Understandably, because gold thrives, its price increases when there's a lack of confidence in the monetary authority's ability to manage the economy, whether because there's double-digit inflation or because there's a lot of turbulence. And then, of course, the gold market began to perceive by early aughts that the Great Moderation was coming to an end, and a bull market ensued. Now, what surprised me, however, is that when it hit 1900, I wasn't necessarily going to call it, a whole lot higher. I was just surprised that it fell back because there was never any excuse. Because the Great Moderation, sure as heck, is over, and turbulence in the economy has not gone away. And so, my question for my colleague about being bullish on gold is, can you explain why we had such a huge bear market in gold from 1900 down to 1100, when one would think that gold should at least have held value given what was happening in the economy?
Well, shall I take that?
Yeah, because you're the bull. I'd like you to do that.
Yeah,
I have an input when.
I think, particularly in retrospect, it was fairly clear actually that gold was in 2011-12 was in bubble territory. there were, we had an exponential rise in the summer of 2012. Remember when Greece, it looked like Greece might be leaving the European Union, and there was that crisis. And gold moved up very, very dramatically there at the end. And you also had the kind of anecdotal evidence of bubbles, where people who had never bought a gold stock in their life were calling me and wanted to open an account the very next day and didn't want to wait. And I think you just had a sort of bubble territory, and it's one of those things as it started to fall, it takes on a life of its own. Now, the problem with gold and other extractive industries, of course, is that you can't turn off the demand. You can't adjust demand to a reduced supply. You can't adjust supply to a reduced demand immediately. If American Barrick has just taken a decision to spend $4.5 billion building a new mine, and the price of gold goes from 1900 to 1800, they don't just decide to cancel the mine and not pay back their debt. They go ahead with the mine. So the supply that's already built in at 17, 18, and 19 as you're on the way up still comes on market. I don't know if I explained that properly, but you know what I'm saying. It's unlike a shoe manufacturer or a shoe seller. If people don't come to my store one week, well, I order less shoes next time I call a wholesaler. But a gold mine doesn't just decide to turn the tap off. They keep on producing that gold. So we had gross oversupply in 2012, 13, and 14 as well. That's only just now adjusted. And I think we've seen the peak in gold production, incidentally. I know that's a different issue, but and we're going to see gold production come down in the next several years.
What's your target price for gold? Where are you rating in gold?
It all depends. It all depends on what happens to the dollar. If you ask me what do I think is going to happen to the price of American capital stock or to IBM, I could give you an answer. But what happens to gold depends so much on what happens to the dollar. I think it's going to be between 14 and 1500 by the end of the year. Some people say that's not a very aggressive prediction, Adrian. We're almost at 1400 now, but next year I think we'll probably see new highs again.
Okay, Keith, I see you shaking your head.
Yeah,
You must
I've got
disagree.
a couple of things to say. The one thing about gold that makes it different from every other good or commodity extant is that virtually all of the gold ever mined in at least 5,000 years of human history is still in human hands. And I think you have to look at all of that gold as potential supply under the right market conditions and at the right price. The amount that is being produced by the miners is a tiny, almost insignificant fraction relative to that vast stockpile. And so that's your supply, unlike in any other commodity where the supply is whatever, in wheat, it's whatever the farmers are cutting off their field this time of year. So I follow a particular methodology in trying to calculate a gold price, which I call the fundamental gold price, by looking at the spread between futures and spot, and attempting to essentially take out what the speculators are doing, say where would supply be meeting demand if we didn't have the speculators in there. And at the moment, the metric that I use is at a record high of softness, of abundance of gold, and it moved up significantly today. And so the fundamental price that I'm calculating right now is about $1,100 an ounce, and in silver it's about 15-something at the moment. So if the market were to suddenly move, so think of it as like a rubber band under some tension between two posts, and the speculators who are using leverage can sometimes be really depressed and they're pulling it down, shorting it, and other times they're pulling it up. Right now they're pulling it up with about as much tension as I've seen in many years of watching this. If that were to let go and relax, we're looking at $1,100. The problem is when you have something that is distended that far under that much stress and it lets go, it doesn't necessarily just relax to even. It can overshoot in the other direction. If that happens, you're looking at under $1,000 gold and $13 silver once again.
I just want to add one thing about tying the last two questions. I think negative interest rates are an incredibly bullish reason for gold down the road. Gene was mentioning that every saver is faced with the choice of paying the government to hold their money in a bond with negative interest rates or put it in cash. Well, that cash option may not be around. I mean, look how extensive negative rates are right now. It's a third of all sovereign bonds. You're going out to 50 years with some countries. You have major economies like Japan and Germany issuing newly printed bonds at negative rates as opposed to negative rates developing in the secondary markets. So this is just a really, the magnitude of this and the extent of it is mind-boggling. So if someone is faced with either holding cash or holding sovereign bonds, with negative rates, they're going to want to hold cash. Well, to the extent we start having a greater war on cash, it's more difficult to do that. People, I think, are going to start looking at gold as a real means to hold monetary value outside of the banking system. I think that's a real option for individuals and companies.
Okay, Bob, I have a question for you. It seems some Austrians, they say gold has intrinsic value. Others say it doesn't. What's your take? Does gold have intrinsic value?
Sure. So here, I mean, the standard answer is no, it doesn't. That with modern subjective value theory, value is not residing inside objects, it's in the mind. But having said that, I mean, a lot of people who are familiar with that truism that I just said, what they're speaking loosely. So what they mean is that you're contrasting gold with fiat currency. So there, the point being that gold is an actual commodity that does useful things for people, and so that's what gives it sort of a backstop value, and that's a way that historically, as Carl Menger explained, that's, governments didn't invent money, that it arose through the market process spontaneously. People were valuing the precious metals for other reasons and then gradually just got adopted as media of exchange. So there I'm being a classic economist and telling you yes and no at the same time.
We want a one-handed economist there, but no. I think the one thing is clear. For example, it's a great story that when it finally became illegal to own gold in the U.S. Effective in 1975, you no longer went to prison for holding gold. The mainstream economists were predicting that the price of gold would just collapse to whatever it's worth as an industrial and ornamental metal, and they proved to be quite mistaken. It's not impossible to do an exercise of what would be the price of gold. You just look, for example, at what they call investor demand or speculative demand. What would be the price of gold if it wasn't valued as a precious metal, as a monetary metal? If it was only valued for its ornamental and industrial uses? We know it would be priced considerably lower. And so that premium is, intrinsic value is an ugly term for Austrians, absolutely. It's only the value, it's subjective value. But the point is, we do know empirically, it's clear enough that there's a huge premium on the price of gold and that it trades as a precious metal. And that therefore the perception is still that it is a monetary metal. It doesn't trade as an industrial metal. So really, the intrinsic value point aside, it is indeed not an industrial metal, but a precious monetary metal as it trades in the market. Yeah.
Justin, can I just add one thing?
Just really quick, for you guys, we have 10 minutes left. If you guys have any questions, you guys can start lining up to the mic. Okay, go ahead, Chris.
I was just going to add, because this is another pet peeve of mine, the use of intrinsic value, and you even see Austrian economists use this term. Bob's right. Nothing has intrinsic value, certainly not gold. Whenever you see that term being used, what they really probably mean is alternative value. So gold and anything that's used as money has to have an alternative value, a secondary supply and demand for that particular good. And that's why in prison we don't have the blood and Crips dyeing toilet paper green and use them as money. You use cigarettes, or when cigarettes can't be allowed, you use cans of mackerel or tuna or something. There's something that has alternative value. You can smoke cigarettes and you can eat tuna. I guess you could eat mackerel. Canned mackerel I never have, but
It's good. It's good.
so I'm going to try one of these days.
Omega-3.
Yeah, go ahead.
As a retiree such as myself, in trying to kludge together 3% maybe to live off my savings, with a combination of equities where I don't feel comfortable as a retiree to get the dividends, and bonds, 8, 10, 12-year maturity bonds, triple B, still investment, but I mean, should the approach be just keep buying longer-term bonds in the, triple, still investment, but triple B to try to get that 3% return, or go to the mattress, or what approach, or could just stay in the market and hope the dividends outweigh the risk?
Well, my inadequate answer, I'll put myself out on a limb. I'm not yet retired, but I do have accumulated some money, and a fair amount of it is indeed in dividend-yielding stocks. And I assume that the prices are going to fluctuate. There will be some bear markets, and you look quite young, and looks like you've got another 35, 40 years to go. And so I would take my chances with decent income-yielding stocks.
And move away from bonds.
That's what I would do, but maybe wiser heads will contradict me.
Or you could start smoking and then reduce your lifespan.
No, I would certainly buy some dividend stocks, and I'll give you a few examples, if I may. One of the sectors, or one sector that I think retirees or soon-to-be retirees really should look at are the business development companies. I don't know if anybody is familiar with these. These are structured as RICs, which means that they don't pay tax at a corporate level. So the dividends tend to be quite high. You pay ordinary, you pay tax, they're not exempt dividends, but you pay tax when you receive them. So these are companies that lend money to small businesses, essentially. Now, some are more aggressive than others. Some lend money to oil companies, some don't. Some invest in overseas companies, some don't, etc. So they're all a little more or less aggressive, but it's a sector you should look at, and I'll give you one stock pick, if I may. Yes. And it's a company called Ares Capital. ARCC is the symbol. Ares is the largest of the dividend-paying BDCs. It's about $5.5 billion market cap, so it's not huge, but it's the largest of the dividend-paying BDCs. It's also one of the most conservative, in my view, very low leverage. They are yielding right now 10.9%, and that is a yield that is fully covered by income, so by their income, net operating income. So I think this is, and we don't have time, we can perhaps later at the next panel on global investing go into all the reasons why they're so low, but I think that's just an extraordinary opportunity for retirees.
Thank you. So doesn't the rise of digital currency hurt the potential value of gold as the monetary alternative value of gold, as opposed to the industrial value of gold, is affected by the fact that digital currency is now a practical, perhaps, thing in the future, and we won't have to depend on gold as a backup to the bad decisions by central banks?
In my opinion, the digital currencies are a great casino in which to wager that the price will go up. And the most aggressive proponents all agree that the purpose of this is to bet, and they don't necessarily frame it in those terms, but they always say their currency of choice, whether it's Bitcoin or Ethereum, is going up. Going up in terms of what? Well, in terms of the dollar. But if you had a choice, at the end of the day, if you had a choice between a strictly irredeemable, not fiat, there's no force involved, but an irredeemable crypto token that is nothing more than a record in a database that a whole bunch of computers agree on, versus something that was redeemable in gold, that you could actually drive down to some warehouse or some center and stick your hand out and get a gold coin, what would you choose? If both had equal utility and equal cryptological wonderfulness, what would you choose?
My question isn't a black and white question. It's a question of the tendency overall. I mean, the viability of digital currency goes up, so then there's less of a need for gold as a backup for fiat currency. That's all. It's just on average. It will affect the price, won't it, in the future as digital
not in my
currencies
opinion.
get better?
I don't think so either, but not for the same reasons. I mean, I think cryptocurrencies are completely viable, but I don't view it as a binary decision whether you're not going to use precious metals or some type of cryptocurrency. They have alternative purposes or different purposes, and they're both useful for different reasons. So I think they will both rise together. I mean, it has its advantages over gold. Mainly it's completely portable, right? But it has its disadvantages. Electricity could go out. So I view them as, sure, all things being equal, demand could go away from precious metals to cryptocurrencies, but I see them both rising because overall demand increases for both.
Given the unprecedented size of the federal debt, an increase in interest rates to what historically would have been normal levels like 9% or even 5% would cause an unsustainable budget deficit due to the increase in interest. How do you see that affecting raising interest rates as a policy tool of the Fed, and what ramifications do you see from that for capital markets in the future?
If I may, the Fed has borrowed something over $3 trillion, for which they're paying now 25 or 50 basis points or thereabouts, to finance a portfolio of about 12-year duration that's earning 250 basis points. If the Fed funds rate suddenly were to rise to, let's say, 3%, they would have a minus 50 basis point carry on a $3 trillion portfolio, which would be $150 billion a year in negative cash flow. If the Fed funds rate were to go to 9%, I think you might as well just stick a fork in it. The whole thing is over, like, instantly. That's your Minsky moment or your Rudy Heavenstein moment if that occurs. And I don't think they can allow it.
No.
Yeah, we might be saying the exact same thing in different language, but I don't know what the latest numbers are. But fairly recently, like if the U.S. yield curve just shifted up not even a full percentage point, then like the Federal Reserve would be insolvent, right? Because they're holding a bunch of bonds. And so, I mean, it's not like they would say, oh, well, it was good while it lasted, and they would lay everybody off. They would just keep printing money or doing it. But that might alarm people, like to say the Fed is literally bankrupt. So there's things like that we're talking about, like it's a precarious system. And yeah, they're in uncharted waters. Or just look at the federal government itself, too. The Treasury, obviously, part of why it hasn't seemed that bad. I mean, there was 3 years in a row where they had $1 trillion-plus budget deficits officially. And so you say, well, gee, why isn't that hurting more? Well, it's because interest rates are so low. But if interest rates even go back towards normal territory, the cost of just servicing that is going to be astronomical.
Yeah, and you have types like Paul Krugman who say, the interest rates, we have this teaser rate, very low interest rates, and there are lunatics like Krugman who actually say, well, let's borrow to the hilt because we can take advantage of these teaser rates. Even he knows that the government never pays down its debt. It's going to ultimately have to roll it over. So sooner or later, we're headed for a real problem. I just don't think it's going to be soon. I think it's going to be a bit later.
Is devaluation a reality in that scenario?
Wait, hold on. We got the mic.
I think you all say that, I agree that we're in a bond bubble. If the bond bubble bursts, you talked about gold, pensions and insurance being affected, but what asset classes besides gold and precious metals will rise, and to what degree?
Who wants to take this one?
I mean, if you're talking about the collapse of the dollar, right, so everybody talks about the money that the Fed has printed, but as long as they're, and I call it borrowing, not printing, which may be a technical distinction. As long as the Fed is borrowing to buy a good asset, now, not that the Treasury is a good asset necessarily, but it has a positive cash flow. So the Fed is paying 25 or 50 basis points to buy an asset that yields, at this point, 140 basis points. As long as it's doing that, there's no particular limit to how long that game can go on. But if the Fed suddenly has a negative cash flow from operations, in addition, if the interest rate is rising, that means the value of the Fed's asset is collapsing. So it would be insolvent because assets are less than liabilities, or liabilities are greater than assets. And secondly, it would be insolvent because it has a negative cash flow with no cure in sight. If the Fed is then obliged to start issuing dollars, not to buy good assets, but to simply meet a negative cash flow, it's over. To start talking about what's going up or down, I mean, you're talking Armageddon here. I think it's time to be thinking about different questions than what asset is going to be going up in that scenario.
Well, should we end on that positive note? Or we're a minute over time. Really quick. Go ahead.
Yeah. Why hasn't Japan imploded with its debt to GDP ratio twice ours, or more than twice? What's keeping it
That's
going?
good. That's an excellent question.
Well, one reason is that 50% of the U.S. debt is owned by foreigners, and that's a huge risk. As the joke goes, if we have to go to war with China, we'll have to do it on money we borrow from the Chinese. Whereas the Japanese debt is by and large domestically held, and that helps a lot. And they have a lot of loyal citizens, I gather. That's one partial answer to you. Very good question.
All right, guys. Thanks for coming. We are out of time.
All right. I hope you guys enjoyed the panel there that took place at FreedomFest. There was so much great stuff said by all those guys. And if you guys want to listen to older episodes of the Justin Moore Show, I have 99 other episodes you can listen to. You can find me on iTunes. Just type in Justin Moore Show, or you can go to my website, justinmoreshow.com. More is spelled M-O-H-R. So feel free, go check back. I basically, all my old episodes, if you're a new listener, I've talked about Venezuela, what's going on there. I've talked about the minimum wage, why there shouldn't be a minimum wage. I've talked about all the former Republican debates that took place. And even though that those debates are, they're old news now, obviously, I break down the basic economic arguments that are said during the debates. And, so if that's more your thing, check that out. Just all sorts of stuff. I've talked about Greece, Cyprus, why your money in the bank isn't safe. And I've talked a lot about gold and silver, why you should own gold and silver, especially now with gold and silver being the best performing assets of this year in 2016. It looks like we indeed did hit our bottom for gold. And so if you're not on that bandwagon yet, I strongly recommend, if you have the means, protect yourself, because with what's going on in the world today, owning gold and silver is a no-brainer. And so I thank you guys for being here. I will talk with all you guys next week, and I'm looking forward to it. This is Justin Moore, signing off.